So with that, okay, let's start with the sign of the cross. In the name of the Father, and the Son, and the Holy Spirit. Amen. God our Father, you know every human heart with divine perfection. Help us draw near to you in truth and justice, ready to be filled with the peace that comes from approaching you with a spirit of faith and confidence in your divine plan. Strengthen and increase our desire to deal honestly and with the purest of intentions, and increase in us a disdain for all things base, hypocritical, and unworthy of your name, Christian. May your every initiative lead us to live for others, persuade us to live the fullest, always at the level of
and the European
dignity and our abilities.
Russia and Putin accountable for what they are doing on a daily basis.
The mayor says Chicago area rallying and will stay
Everybody go on mute.
Kharkiv indefinitely until the war ends.
Could we go on mute, please? Somebody's talking. Thank you. Bestow on us the true discernment and courage to pursue with steadfast hearts all that is noble and worthy. Bestow in our hearts scorn for vice and injustice. Bestow on us the title enemies of fear when truth and right weigh in the balance for family, company, and community. Let us resist all profanity and hold dear to the sacred things of life. Help us to form new and lasting friendships, opportunities for action, contempt for laziness, and indifference, and hearts deeply in love of service to spouse, children, and friend. Never permit us to turn a blind eye to those suffering in mind, body, and spirit. Place in each of us the generosity to be your eyes, your ears, your hands, your feet, and your love. Help us to maintain whole and the entire statutes and character that we profess, and show all who encounter us a strength of mind and character becoming of your Son, Jesus Christ, our Lord. By the help of your grace, we ask that whatever be diverted from this endeavor. Amen. If there was ever a poignant message in that prayer, it's today. Well, with that, let me shift gears and introduce all of you, Steve Auth. Since there were a number of new members last year, we actually had 38 new members. You probably saw Steve's bio in the write-up, but let me just add a few other items. Steve was actually one of the founders and actually is the very first member of Lumen 15 or so years ago. He's a very active board member and he runs the Naples chapter. You saw that he's done a number of other things, but he's also a author of a couple of books, but the most recent is A Missionary on Wall Street that I would urge you to read because it's very inspiring. He runs a mission down at Old St. Pat's in New York, which I've actually been to once or twice. It is a very humbling but very spiritual experience. So I would recommend any of you in the New York area to participate. His day job is significant. I've been following Steve's messages and commentaries for the last 5 or 6 years, and it's uncanny how he and his team in January put together a forecast and a series of venues for the year, and how he comes almost dead center on finishing the S&P on what he forecasted at the beginning of the year. He's very measured. He's a terrific person. And given what's going on in the world, I can't think of a better person to have a speaker event. So Steve, we'll turn it over to you. And at the end, if we have time, we'll do some Q&A. So thank you for joining us.
Thank you, Bob. Just to put a few disclaimers out there, Bob only remembers my good forecasts. So I've had some bad ones. And I'm really very flattered that you all would show up to hear what I had to say. There's several of you out there, I know many of you guys and women, I see some women on the call, know more about this situation than I do. But let me give you my perspective for what it's worth. And I always tell my analysts, start with the conclusion. So I'll give you that first. And my conclusion is that in terms of what we're doing at Federated within our balanced portfolios, we are holding to what are really basically modest equity overweights that we put in place. As you know, we've been more overweighted, but we took, if you follow my stuff, and if you don't, by the way, if you just send a little email to Pivy, she can send that on to Mary Ceresi, my assistant, and Mary will put you on her distribution list for all pieces I put out, which I do when I feel like I got something to say, but roughly every few weeks, something comes out from my desk. but if you follow those pieces, we took a couple of points out of, on a scale of 1 to 10, out of the equity overweight we had in place all of last year. Back in September, we took another point out in January and took us down to 4 out of 10. I put it in that terms because everyone's got their own risk reward and their own neutral plan, if you will. So, but to give you a sense of where we are, we're kind of at a modest equity overweight. All those equity sales that we did, we put into cash, and because we felt that cash was probably in the near term a pretty good option relative to bonds. And so we're overweight cash and we're a little bit overweight equities. And that's where we sit today. And within equities, probably fairly, no, maybe not so obvious, I guess, especially when we did it last September, when all the growth stocks were the rage. But we are significantly overweight valued stocks. Got into that trade too early, probably, frankly, as I said, middle of last year, but and underweight growth stocks. And we own, virtually nothing in what I would call the bubble stocks, which I think are still a bit of a problem. So that's where we are. We think it's too late to sell here. For those thinking about that, we have a kind of muted forecast, which I'll get into. We might lighten up some more if we get a rally up to 4,600 on the S&P. I don't think we will in the near term. And our plan is to reinvest the cash we've raised over the last 6 months down at the 20% correction line, which we expect we'll be getting to at some point on the overall market, which is around 38.50. That's kind of what we're waiting for. So that's the conclusion. Let me just kind of give you how we get there. We had an outlook piece that we put out at the very beginning of the year, calling for muted returns on the S&P. We thought we'd probably be in single-digit range for the next couple of years. And the way we got there was that we see economic growth slowing over the next couple of years, earnings growth also decelerating, but still positive. But that's offset by rising. We thought the inflation situation was more endemic than the Fed thought. We thought last summer they should have started hiking. So we've been, we would have been the real hawks of the Federal Reserve if they ever let us into their FOMC meetings. So we thought they're behind the curve. They had some catch up to do. Discount rates were going to be going up on stocks. And we thought that valuations would be coming down. So when you combined valuation compression with modest, though still positive earnings growth, you got kind of modest returns on stocks. And those returns heavily concentrated in value stocks that were both cheaper and probably had a little bit of a wind at their back in terms of the economic cycle, and very underweight growth stocks, which are the ones that are going to absorb all the valuation compression. So if I now look at where we are with the Ukraine war, what has that done to change things? Broadly speaking, I think what it's done largely is exacerbate those trends. It should take, we think, and I'll get into the scenarios in a moment, but broadly first, it's going to take some growth out of the global economy for sure. It's going to exacerbate the inflationary pressures on the commodity side, and then exacerbate the pressures on the ECB and the Fed to hike. So it's not a perfect outlook, frankly. I put out a piece last week on the scenarios ahead. Normally, we just talk about a base case, and we always have scenarios, but with our clients, I tend to focus on the one that we usually have a very high level of confidence in a base case scenario. Sort of Bob alluded to that. I got to tell you, this time around, we don't. And I do think you got to review the different scenarios here. it's like playing cards. I think of someone I know who really likes to play hearts, and it just makes him crazy when he plays hearts with someone who's an amateur who doesn't know anything about playing hearts, and because they play all the wrong moves. So that's a little bit what we're dealing with here. Like we've got players in this war here that, are not necessarily always operating rationally. So it's really hard to forecast how this goes. And by the way, I mean, as an aside, I'm completely with all of you in terms of concern about the people of the Ukraine. I mean, first and foremost, it makes everything else we do seem trite and unimportant. But for the moment, I'm trying to focus in on what the purpose of this call is, not to try to talk about the humanitarian crisis, which is something none of us have seen in our lifetimes. But in terms of the scenarios ahead, we have a decision tree of possible scenarios that we've developed. And, with our probability assessments, which we're changing almost daily, depending on the kind of data that we're watching carefully on the war in terms of personnel losses on both sides, military equipment, what's going on with commodities, what's going on the forward curves, et cetera. So we have a whole framework that we've developed to sort of think about this new problem that we have. But if I boil it down for simplicity's sake, that whole decision tree probably collapses to kind of two rough paths forward. One is an early end to the conflict in the Ukraine. And the other is a prolonged end to the conflict in the Ukraine. And the early end is some combination of the Ukrainians simply giving up because they can't take the civilian losses as they mount, or the Russians giving up because they can't take the military losses, and it's harder and harder for them to tell the story back home about this being a limited engagement. We've got the probability of those two together at about 40%. I don't, so in other words, I think it's actually significant. And I think part of our recommendation of how to position yourself is taking that into account. I don't think it's the most probable outcome, but it is significant. I mean, the Ukrainians, to me, seem really dug in. They've captured the world's attention, obviously. And it's hard for me to envision them at this point giving up. I think they're pretty tough people. And of course, the Russians are pretty dug in too. But between the two of them, maybe the Chinese get engaged. I think that might be a little bit of a pipe dream, but maybe they do and force the Russians to the table. We'll see. In that scenario, I would think that what happens is, first of all, the markets breathe an enormous sigh of relief because they can take off the table the tail risks things, which I'm not even going to talk about, but there's obviously tail risks here of this thing accidentally becoming World War III, at least in terms of a military engagement, but even going nuclear. What I tell clients when they bring that up is I just tell them, well, it's best to get your prayer life in order in terms of dealing with that outcome. But, so those tail risks coming off the table would cause, I think, a general relief rally. I wouldn't be buying that rally either, by the way. We would probably hold our position, might even lighten up in that if we get it. The reason is that I think even in that lower probability scenario, though a reasonable one, you're going to have more pressure on commodity prices than even we were sort of commodity bulls, as you guys know that follow our stuff over the last 6 to 9 months, particularly oil. We had oil at 90, then we raised it to 120, and that's kind of where we got it now. But it would, I think even a quick settlement is going to increase the already significant problems that we have in the commodity space. The source of those problems, by the way, is just that there's been a massive underinvestment in almost all commodities, particularly carbon-based ones like oil over the last 5 or 6 years. The capital markets have been on strike. You've got all the environmental players and the green lobbies in all these countries trying to shut the industry down. Even the management teams, and we talk to all of them because we have big investments there, hate their own companies. They don't want to drill any more wells. They don't want to be Charlie Brown with the football, the whole story. So there's been a massive underinvestment here that's going to take years to fix. But what I think would happen, even in a quick end to the war, is that Western nations are going to increase domestic production, first and foremost, to simply replace Russian oil, even if there is a settlement. Because I think most people have said, my goodness, being reliant on Russian oil and gas was not a real good idea. And to be in the hands of this madman is just not going to happen. So whereas in our forecast, we've been saying 120 oil. And whenever I get asked that on TV, I said, look, it's not a question of the number. What you got to understand about what's different about our view is that we think it's staying up here for at least 2 to 3 years, not for 2 weeks. So the problem here is that this thing could really be prolonged now, because I think the energy production that we saw coming online gradually over the next 6 to 24 months in the US in particular is now going to get dedicated to replacing the 5 million barrels of Russian oil that we're currently importing. Russia produces about 10 million barrels a year. They also produce, by the way, 25% of the world's wheat, Russia and the Ukraine. So that's another thing to think about. So I think that's what would happen. And so it would keep the supply shortages pretty tight. So basically what I'm saying is, even a quick end of the war, to me, it increases the inflation pressure. It probably puts some more pressure on the Fed to hike, increases the valuation problem, and probably takes a little more steam out of the growth. I do think there's a lot of very healthy things about the economy, by the way, that should cause growth to continue even at a slower rate, but it takes the whole scenario down. So in that 40% scenario, we're pushing out our targeted numbers for when we achieve what at the time seemed a muted forecast for stocks, 5,300 off of a base of 4,800, but now is a fairly significant one. We'll probably push it out a year. But I think we kind of would be in that kind of slower path to pretty much the same end game. The 60% scenario, and who knows if we're right about these probabilities, you could put your own percentages on them and then run with my outcomes and come up with your own idea. But we're putting it at 60% that this thing goes on for some extraordinary period of time, at least 6 months. And the Ukrainians to us seem very dug in. Our contacts in Poland, I have some close friends out there telling me the Poles are dug in. And I think they're going to do everything they can to keep supplying the Ukrainians. They'll fight from the rubble, in my mind. And Putin has kind of painted himself into a corner, so he's going to try to blast his way out. And he's, for those dreaming about a coup or something, I think it's months away at best. He's got such tight control over the military and the security apparatus, and that's all that he needs. So you add all that up, and this goes on longer. That adds to the disruption in the supply chains. It adds to the inflation problem. It slows growth further. I think it raises the risk of a stagflation environment. And maybe not the end of the world. Again, a lot of positive things going on in the overall economy, but it certainly would, that would be one of the conditions for a further drop in equities to the minus 20% level. Now, for those of you who aren't watching carefully, we've already achieved a 20% correction, which is typically the kind of correction you get in a bull market where you're having a modest recession, which is kind of, I think, in the 60% scenario, what you'd be looking at. It's not atypical. That's how we came up with the 20. But several markets have already made a 20% decline. Like the small cap market, which is the broader market, has already gone down 20% from its peak and is making, frankly, slightly higher lows right now. Today, the NASDAQ finally capitulated and made it down past the 20% mark. That was a market we've been watching. The international markets have tried to get there. They're not quite there yet. They're down 15. So the broader market could follow, and I think it probably would in my second scenario. And that's the level we're waiting for, that we think the risk reward would be better to add to equities. Final point is, we're not recommending, selling everything and running for your lives. That's never a good idea. I mean, if you take a 3-year view here, which I think is the only one you can really take, unless, we're all vaporized or something, the economy is going to be bigger. The Fed will have made it through this cycle. We'll be reaccelerating. We're not going to have a global financial crisis like we had in 08, 09. The banking systems are very, very healthy. And very well capitalized. So I don't, a lot of people hear recession and their experience is 08, 09, they're thinking it's kind of a new Great Depression. I don't see that at all. So more of a plain vanilla recession. Inflation should be coming back down by then. A lot of these supply constraints will be corrected, probably be oversupplied in commodities by then, et cetera. So, if you look out 2 or 3 years, you want to be in equities, and that's why we would continue to lean in that direction even here. But I don't want to, go out over my skis with our clients until we see a better risk reward. And in the meantime, our equity allocations are heavily tilted towards defensive stocks that frankly are still pretty cheap with pretty good dividend yields on them. So maybe last point, just some things. I mentioned bubble assets that I wouldn't touch. I'll give you 3. I mean, we've had this bubble monitor we've been watching now for over a year. But the ARC funds, she owns a lot of things that, in my mind, have a long way to go still. When she's down 90% from her peak, maybe that'll be about the end of it. So I think she's down about 60, so she's making progress, but we're still correcting there. I think that's a falling knife. Bitcoin is a bubble in my mind. I have a book I'm working on, among other things, called 40 Years, 40 Lessons. One of my problems is I can't condense the lessons I've learned to 40. I got to 40 years, but I got like 65 lessons, and I'm learning more in the last 6 weeks. So it's just, and most of them the hard way, by the way. So, but anyway, one of them is, from the TMT bubble, beware of taxi drivers bearing stock tips. And the corollary there is beware of 23-year-olds explaining Bitcoin on CNBC. Because I can't tell you how many times over the last 2 years on one of the big networks, I've been asked to explain Bitcoin, and I just tell them I can't explain it. I invest in things where I know how to, analyze their forward cash flows and how to discount those back to evaluation. This thing is simply what someone else is willing to pay for the tool up, basically. So, I don't know, but I'd say that one's probably got more to go. SPACs, we stopped investing in them almost 12 months ago. We could see the market was just gone crazy. I think they're in a bubble. But I think the broader market is actually okay. Broadly. So with that, Oh, and did I mention any of the risks we're watching? Okay, just four. One, commodity markets. We're watching them very carefully. They could really upend us. I'm worried about the wheat thing in the Ukraine. Another one is, financial impact of a bad trade we haven't considered. Like we were watching the nickel trade pretty carefully a week and a half ago when that blew up. Turns out, David, by the way, JP Morgan had that big position, but they could handle it. They're extremely well capitalized. But so we're watching for that. Some trade that goes bad that really has an outsized impact. We're watching for escalation in Europe. I think that would be a very bad thing. And then the other one we're watching is China. And I got to say, I'm praying that the Chinese get their acts together here and back away from this guy. Because if they don't, then it's going to become very tricky. I mean, it's one thing to say we're never going to invest in a Russian stock again, which you heard us say about 2 weeks ago if you're watching the press releases, but China is a big hunk of every global company's businesses. It's a big hunk of all the global equity benchmarks. My read on Xi is while he's a dictator, he's not crazy. And if you read the history of China, a lot of you know I'm kind of an historian. Over the last 3,000 years, the one thing that Beijing, the Beijing leadership's problem basically is try to control a country where, the politicians in Beijing are outnumbered, 100 to 1. And the way you do it is you keep the peasants happy. Once they march on Beijing with pitchforks and torches, you're in trouble. And I think Xi understands that and is probably not real happy about the global dislocations going on here. And therefore, the play for him is to gain some prestige to try to push Putin to pull out of this thing. That's what I would bet on. But we're watching this carefully. If he goes the other way, and the war with China, it kind of spreads to China in some ways, maybe the economic war, I think that would be a really bad outcome for the global economy and stocks. So that's kind of where we are. I guess we have time for some questions. Bob, if you want to moderate. I'm sensitive to the fact that we've got multiple people on this call who are more intelligent on all of the issues I just talked about than I am. So questions or commentary or disagreements are all welcome. We're all brothers here, so you won't insult me.
Take yourself off mute, anybody who wants to speak.
Hey, Steve, it's Alex Perry here. Can you hear me?
Yeah.
Hey, so two questions for you, actually. First, what do you think Putin's end game is here? What do you think he wants out of this conflict? And then two, do you have, any historical perspective on market cycles that are similar to this, where there's sort of been sustained consumer inflation, and what's your perspective on what sort of asset classes perform best in, similar market cycles here?
Well, on the first question, I got to say, I wish I really understood. He seems like he's out of his mind. But if you read about him, it seems like he wants to restore the borders of Imperial Russia, that sort of, in a way, the motivation of Hitler in starting World War II, not to draw an analogy that's kind of ugly, but they felt that Germany was really betrayed at the Versailles Treaty after World War I, and he wanted to get it all back. And that's kind of how he thinks that, the Cold War termination in the 90s basically disemboweled Russia, and he wants all the parts back. He's an anachronism in my mind. He's living in another century. We're not in a world now with the internet and everything else that you can just march in and take over countries. The Ukrainians don't want to be part of Russia, and they're not going to become one. So if he does try to occupy a country, it's going to require most of it. This is a country of 40 million people, so it's going to require most of his armed forces. It's going to drain his country, and he's not going to have any revenue. So that's what I think he wants. But now what's he going to get, and is he willing to settle for something in between? Historical reference points, you can look back to the 70s when we had, the last time we had a significant stagflationary environment. I don't think this is quite the same, but it wasn't a good environment, that period. I think this is more of a temporary problem. There in the 70s, you had a very constrained US oil sector. We hadn't made the investments. We didn't really have the technology to produce more oil, and OPEC was completely in charge and kind of foisted it upon us. There's some similarities though, but yeah, that's probably the closest analogy.
Thank you. That's really helpful.
Jorge Dickens has his hand up.
Hi, Steve. How are you? Thank you for that excellent presentation. Quick question. You mentioned oil. Do you think there's still value in oil stocks? And my question is because of this environmentalist movement, so many institutions have left the space. And I would anticipate that by March, in the first quarter, these oil companies are going to have blockbuster results that are really going to show tremendous cash flow. But I worry that the big institutions probably still are not going to get in. So is still a value play, or should someone just buy that and think that it should be just a dividend play for the time being, because the large institutions are still not going to get in? I mean, I look at the prices of BP or Shell, and they're still below the pre-pandemic levels, which at oil at 120 sounds crazy. So
yeah, I think there's absolutely still value there. Couple of points. At the end of '99, during the TMT bubble, growth stocks outperformed value stocks by 115%. At the end of 12/31/21, growth stocks outperformed value stocks over the previous 5 years. I gave you a 5-year number, by 135%. So the delta here of underperformance is actually above what it was in the most classic overblown bubble of our time. So there's a lot of catch up to be done. And just look at the valuations or look at the cash flows. I mean, Exxon is trading almost at single digit multiples. Its dividend yield, I want to say, is about 4.5% right now. I look at the futures curve on oil, and that, because these stocks will eventually respond to that. The 12-month out futures curve on oil today is at 83. I'm not at 83 12 months out from now. You're dreaming, people are dreaming. So I think the stocks reflect the forward curve. Most analysts simply use the forward curve. They say, I'm not a macro guy. Okay, fine, but I'm telling you, it ain't going to be $83 12 months out. There is no way you can get there, given the supply, unless we have a severe recession, which I don't see coming. So I think there's still buys here. And look, I mean, you got to reset your expectations. I'm telling you, I think equities in the next 2 or 3 years are, even off of these levels, probably high single digit performance. That, pales compared to what we're all used to, but compared to bonds that are going to be negative, it's not bad. And if you can get half of that in dividend streams, I think it's probably okay.
thank you.
Any other questions?
Yes, Jason Suarez.
Here's a
Hey,
guy
Steve, how are you?
who knows more than I know. Well, yes, Jace.
Steve, I'm just curious, what your thinking was on the Fed before the invasion and, where you are currently, because as you said, you could make the case that this is highly inflationary and the Fed will have to go further, but you could also make the case that, oil prices will destroy a lot of demand and the global economy could really decelerate here and the Fed will have to be much more ginger. So I'm just curious which way you've gotten pushed on that.
Yeah, I was at 7. I mean, I you know, because you and I talk. So I've been screaming about the Fed since last summer. I think they're I'm a big believer in getting your framework right before you analyze a problem. The Fed had all the wrong framework. They were analyzing this thing like it was 0809 and it wasn't, and they just completely screwed this up. They will go down in history, in my mind, as almost as calamitously bad policy as the 32 Fed. So yeah, I had them at 7 and I thought we'd do 50 this week. And I thought the market would actually be happy about 50 and 50 to get a head start so that it could look forward to an easier pattern going forward. Now they can't do 50 because, as you said, you're in a war and it would be unpatriotic. So they're going to go slow and they're going to eke it out and buy some time and see what the demand destruction impact is of all these things. I look at demand and say, incredibly strong right now. I mean, obviously, right? And balance sheets are in good shape. So I kind of always, the optimists, view the so-called demand destruction from the perspective of taking some steam out of the economy, which will actually help the Fed. And I think like oil prices up here, okay, today we're back down to 100, but let's say we're going to stabilize around 120. I think that's probably worth 3 hikes or something. And I think in any case, they'll go slowly because of all the uncertainty outcomes that you just highlighted and I've been talking about. So I guess that's good. I'm not sure. I think it, I don't know what else they can do right now. They have to go slow, but I'm worried that slow isn't going to cut it, given where inflation is. And they're going to have to go fast later, and then maybe they do crash the economy. They're trying to achieve a soft landing here, so it's tricky. But you could make the case that the current problems, in a way, thank goodness, are coming from the perspective of an overheated, very strong economy. So in some ways, everything I've been talking about may be actually, ironically, helping the Fed achieve a soft landing. So we'll see. We got to watch how this evolves carefully over the next few months.
Thanks, Steve, and thanks for doing this today.
Thank you.
Steve, I have a question, if I may ask. There's been a lot of press the last couple of days about the Chinese stock market moving down very rapidly and very severely. What's going on there?
It's been in a bear market for some time. I mean, she kicked it off by, going after almost every single important industry in China from a regulatory perspective. He's playing the long game. He's trying to make some structural changes there that he thinks will be better longer term. He might have been more or less right, but I think the latest drop over the weekend is a combination of 2 things happening at the same moment. It's hard to dissect it. One is the COVID numbers coming out of China have been alarmingly high. And this has been something we've been worried about for over a year now, that because they had pursued this lockdown strategy, there was no natural immunities built up in the population. And you better have really good vaccines then. And the answer is they have really bad vaccines. And so you combine those 2 together and you are exposed to what is now happening. And so they shut down Shenzhen over the weekend. For those who don't know, Shenzhen's the equivalent of 2 New York cities and other cities around China. So it seems to be spreading. So one, people are a little worried about that, frankly, kind of the equivalent of our March 2020 lockdown. And then, although I don't know that the thing is as deadly right now, so that may be the good news. Then the second one was there were rumors over the weekend, and all day long, it's been back and forth, depending on what sources you listen to, but that the Chinese were going to ship arms over to the Russians. And if they do, that goes down the scenario I told you we're tracking, which is what if China comes out on the wrong side on this thing and you start getting into a economic war with China. I mean, you could argue we're in one already, but I think it's more of a intense rivalry at the moment, but that would be bad. I don't think they're going to do that. That's just too disruptive to their economy, but I think those two things together, and then the risk that of these things coming out in the next few weeks, leave lack of bidders for the China market at the moment. One of my lessons in 40 years, 40 lessons, Jason, you'll appreciate this. It's from, I don't know, Jason, this might have been before your time at Prudential, but the value guys over there at Pro, Tom Jackson. I was at a board meeting with him once, and one of the directors asked him, why did that stock you own went down? He goes, well, there were more sellers than buyers. That's usually the reason something goes down.
Oh, that's great. Any other questions?
Yeah, Steve, it's Terry. Love you,
Hey,
brother. How
Terry.
you doing? Could you talk some more about stagflation? Obviously worries us all. What has to happen to get us into that scenario?
Well, you have to have the economy kind of go through something more than just a recession, but it kind of go into a restricted growth mode. And I don't think we have the ingredients for that in our economy, although you could argue that the current administration, if left to its own devices, would pursue those policies. If you remember that piece I put out about the 4 Fs, we had this sort of modest forecast with the 4 F risks. One was foreign, because I thought Afghanistan had opened the door to Putin in Ukraine. I didn't think he'd actually invade, but I was worried that one, and the Fed making a mistake, and more fiscal spending, which we don't need. But the fourth was federalism and weakening through executive order, over-regulating economies and just strangling the economy. So you need a kind of stranglehold on the economy, I think, to prevent growth. But we've got so many great drivers today that we didn't have in the U.S. economy. The technology revolution, the biotech revolution, the digitization of everything. And we're world leaders in all this stuff. And that dynamism, I think, is really hard to crush right now. And I know a lot of you got involved in private equity stuff, and you see the stuff that's in the pipelines. There's a lot of innovation in the pipelines, and this is not ending. So I think that keeps us out of the stagflation scenario, unless Biden's people really go after it and kill it. But I don't think they will, because even they kind of see the value in that. The inflation part, I think we've got the ingredients in place for some significant inflation, obviously. I do think there's some self-correcting mechanisms here that will help the Fed tighten it up, as Jason and I were talking about. I think that part of the equation's there, but it should moderate, hopefully, for the next 2 or 3 years. So I would call it like stagflation light, maybe, is what we're thinking we're heading into. And in those environments, the kind of stocks you want to own are companies that have enough pricing power to keep up with the inflation on the revenue side and at least grow nominal earnings and nominal dividends. So that's kind of why we like these conservative dividend strategies, because we think they can continue, at least in nominal terms, to grow their dividend streams and do okay there. I think it's a tough environment for growth, and really aggressive equity right here.
Thank you, Steve.
Michael Lyons says on that one. Michael,
So my question is around the escalation. I know none of us probably expected for Putin to invade, but he did. What are the escalation waypoints that you see that we should start considering rebalancing or looking more at a wartime investment strategy? And that might sound a little bit crazy, but at what point should we be looking and reconsidering that? And what would that strategy look like in your eyes?
Well, okay, first of all, if he goes nuclear, as I said, probably just get your prayer life in order, because it's not going to really matter at that point. So let's put that aside. I think that's unlikely. And I also think it's highly unlikely that the Russian military would execute a nuclear order anyway. So what we're really talking about is an extension of the conventional war into a NATO country. If you go by the idea that the madman is trying to recreate Tsarist Russia, there are some other territories that used to be part of the imperial borders of the empire, most notably Estonia, Latvia, and Lithuania. And possibly he goes after them, but they're pretty small, and they are a NATO country. So if he does, it's like biting off. I mean, it's not gonna mean that much to him, and it's taking on a pretty big gorilla for a guy who has got his military already bogged down trying to take over a country that doesn't want him. So, that would be one. Another would be, what if he accidentally drops a bomb over the Polish border? That's a NATO country. As I said, my friends in Poland tell me the Poles are really fired up here. They don't want him on their border. And they are dug in. So, they want to send MiGs over there. He's sent a message today when he blew up he sent some missiles over there to that depot where they were bringing over equipment from Poland. So he's trying to terrorize people into not, I don't think it's going to work, but that would be a kind of an accidental. I mean, if you look at like World War I, how did that get going? You look back at it now and say it was kind of stupid. Well, it was a series of accidental things that kind of gradually drew everybody in. So, accidentally blowing up something in Poland, that would be, that would probably bring NATO in. I think he would really, on a conventional basis, have a problem at that point. And then, I guess, China getting involved, but I don't think they will, but I think that's how it would get extended. But as I think through the possibilities, honestly, I don't think it's going to extend into NATO. I think he's not that crazy. Well, we'll see. I didn't expect him to invade Ukraine either.
Well, one of the problems with these dictatorships is that the military leadership won't tell them the truth. So he probably was given a state of readiness and a state of execution that was just what he wanted, what they think he wanted to hear.
Yeah. So that's right. And the guy running the military, as you know, is like one of his best friends. He's not actually a military guy. But, the reality on the ground now is quite different. His army is stalled. They outman the Ukrainians 10-1, and they can't make any progress. And their losses are mounting. So, and, from what I hear, morale in the Russian army is really bad right now. So we'll see, where this goes. But if he had any dreams of going any further in Ukraine, I think they've probably already been pretty well put to bed. But as you said, maybe they're telling him everything's going fine. I mean, he must be wondering why they haven't made any progress.
Sarah Coughlin has her hand up. Go ahead, Sarah.
Hi, thank you. So I appreciate getting to join. My father-in-law, Kevin, kindly shared the link. So I support the Chief of Staff Office for the CFO at Morgan Stanley, and every morning listen to a market update call and circulate salient highlights. And I hope that the company is providing information like for the benefit of their clients and their clients' best interest. But my question is around, how do you inform your views in an era of cancel culture and misinformation to ultimately shape what you're equipping your clients with in good faith?
There's some sort of veiled question there, Sarah. I'm trying to figure it. We have a pretty good relationship with our clients, and all of our core values kind of fit with things like treating people with dignity and respect and stuff like that matters a lot to us. Integrity, it's kind of our reputation over the years. So we don't worry too much about cancel culture. I mean, we try to call it like we see it. Because at the end of the day, you're not going to have your clients for long if you make up stories to them and hope they don't notice. So we try to keep it pretty straight. My pieces are not edited by, well, I guess they are edited by our editing department, but they basically are, there's not like a PC police editing our stuff and things. But it would be unusual for me to, I'm not sure what you're thinking I might say. But,
oh yeah, more just, are there particular thought leaders that you really respect and follow, and you're incredibly busy, but you stay abreast of all of the market themes? So do you have any recommendations for like key sources to follow? I'll certainly get added to your distro, but others in a world of like lots of voices that you respect in regard to inform your views.
Yeah, I mean, I'm in touch, as you might imagine, with most of the economists and strategists on Wall Street, and you could make a list of the top 5, and you would know that, I'm on a regular contact with them. So I do keep certainly apprised of what they're thinking. But we at Federated generally kind of come up with our own view and our own framework. We don't, we kind of use other economists and things as a kind of bouncing board for our own views and go back and forth and just challenge our views. And sometimes it causes us to change, but we're not sort of naive digesters of input, really. So, but yeah, you could, you would know. In fact, one of the ones I respect the most is actually, I don't see Jason on the call here, but to me, one of the very best strategy teams on Wall Street is Strategos, led by a Lumen guy, Jason Trenner. He's very, very good. ISI, Evercore is good. Nancy's shop over at Cornerstone, I think, is really, really good. So, yeah.
Well, we're just about there, and there are no further questions. Are any last comments from anybody? Maybe not. Well, Steve, this has been terrific. I can't thank you enough on behalf of Lumen. Thank you for your time and your insights. We're going to, we've recorded this, so this will go on the Lumen app in the next 24 to 48 hours. And with that, we'll just say thank you again and have a nice evening.
Thank you, everybody.
Thank you,
Okay,
Steve.
bye-bye.
Very
Thank you,
insightful.
Steve.
Thank you.